Okay, and I'll probably let Austin really do the bigger intro for you. However, I got connected and found out Brian and this DSCR product exists because Austin made me aware. And so Austin was the first one of our group that I know of that found Brian, found the product, and Austin is now has clients for this product. And it just seemed different, like something that I don't know anybody else that has. So we definitely thought he was worth bringing to the mastermind so you all know that Brian and his product exists. So, Austin, I'll turn it over to you and you could turn it over to Brian.
Way to go,
Thank you,
Austin.
Alicia. Appreciate it. Yeah, Brian, I think we first got in touch a month ago, and
Yeah.
you somehow brought up that DSCR one-time close program that I never knew existed at any other level. So I think you guys are the only one in that space that does it. If there's other
Okay,
companies that do it,
sorry.
they probably have a lot more expensive rates. So you guys have a program that does long-term rents, and I think it's short-term rents, DSCR. I'm submitting over the short-term rents, DSCR one-time close to you guys probably next week. So, Brian, look forward to hearing more about the program and what you guys do.
Okay. Thank you, Austin. Yeah, I want to share my screen if that's okay.
Excuse me, can I make a suggestion, Trip? You might want to mute Alicia since she's
I
back
don't
there.
know that I can.
Texted her to mute herself. I just texted her like, hey, can you mute your
All right. As Austin said, we just recently launched a one-time close construction loan, and we broke it up into three categories. One is the traditional Fannie Freddie type product that meets Fannie Freddie limits. We launched a DSCR for all of our real estate investors, and on the DSCR for the real estate investors, it will work with 1 to 4 units. It will work with long-term, short-term rental income. If they loan to values will run about 75%, loan limits up to $2 million. So if you have a borrower who currently owns a piece of land and they're looking to build on that land, and I'm seeing a lot of projects where they've already pulled permits or they've got land and they want to build on it, we will give them credit for that land towards the LTV. So if there's $1 million bill and that land's worth $200,000, they're all cashed into it. May only be 5%. We'll do a loan at 75 LTV or 70 up to 2 million. 75 typically goes to about $1 million with a 740 credit score. In fact, let me share the screen with you guys so you can see the matrix. I sent Erica a copy of the matrix. I don't know if she sent it out to everybody. Let me grab this. Share. Okay. Can you guys see the matrix here?
Yeah.
Is it so small you can't see it?
You can see it then.
Okay. So one-time close, we will, during the appraisal, once we get the file in, we got the plans, permits, everything's signed off, we've reviewed it, we will order an appraisal. The DSCR ratio will be calculated based on what the appraiser tells us it is off the 1007. Now, with short-term rentals, we're going to need air DNA, VRBO, something to justify that rent. We run a minimum DSCR of 115 for 1 to 4s. STR, we do a 125. They have 12 months to build the property. It is a build and hold. It does come with a 3-year prepay. Rates right now in the construction are seeing about 8 and, depending on credit scores, I'm seeing stuff today at 8 7/8, 8 3/4, 9 1/4, depending on the credit score. Once they get down close to the completion of construction, and our construction team will work with them for the draws. You can stay involved with the draws if you want. You can monitor it. We'll reach out to the borrower at about 45 days before the 1-year anniversary is up. We'll have a really good idea where the contractor's at with the completion of the property, because we've been doing the disbursements, we've been doing the inspections, we've got all that stuff going on. We'll do a float down on that loan or loan modification. We looked at one last night. I think our rate was like 8.8875. And if we did a float down on today, you'd be at about 6.5 on that same DSCR. So the borrower doesn't have to go out and get new financing. We're not pulling new credit. We're actually going off the same credit that we have, as long as there's been no major changes in the borrower's profile history or no major problems with the project. They'll just do a rate adjustment, lower the rate, borrower moves his tenants in, and he just continues with the project as the brand new construction just completed and moves on with the new property that he has tenants in. Things we won't do on it, we won't do condos, manufactured, weird properties like that. But pretty much all single family 1 to 4s, we will look at them. If you're looking at resort areas, for a lot of short-term rental, it needs to be a major resort area, major ski resort, Aspen, Vail, stuff like that. It can't be some small town out in the middle of nowhere, Big Bear, California. You know, it's probably not something they're going to do short-term rental on. Just not enough of them up there to give a big market. But if we can validate it and the market's good, they'll definitely want to take a look at it. Does anybody have any questions at this point? Okay. Reserve requirements. They do need to have reserves. If loan amounts are up to $1 million, only 9 months reserves. Now, the interesting thing here with the payments, when we do the disclosures, if the property is free and clear, we're not paying off a mortgage. We estimate a payment, what the payment's going to be at about halfway, 6 to 8 months out, based on what we think the draws are going to be. It's an interest-only payment. So the interest-only payment is based upon the actual balance that they have pulled down at funding when we close the loan. If they need a draw to complete plans, architectural designs, things along those lines, we can do it. If they need an upfront draw for have materials deliver the property, they will do that. Just trying to really hit a lot of the highlights here. This is kind of unique here. Don't see this being used much, but gift funds. If the borrower has at least 10% of their own funds into the project, they can accept gift funds from an immediate family. It just cannot be used
I
for
know I
reserves.
turned the volume down so we can hear them, but I didn't mute myself. Sorry, guys.
Well, stop talking.
Hi, Brian. Sorry for
Yes.
disturbing you. I'm having a hard time to read the letters.
Okay.
Do you think you can zoom in the presentation material? Oh, wonderful. Thank you so much.
No problem.
So I have a question. How do
Yes.
you are there a limited amount of contractors that they can use? That would be one. I'm just going to ask you a series of them. The other would be who structures this? Do you have like an Excel spreadsheet that we can use to plug in the numbers to come up with that? I see you have a 10% contingency built into that.
Yes. Mm-hmm.
So would you also finance modulars instead of manufactured, no manufactured, but with modulars, would you still be putting a 10% contingency on the cost of the modular, or would that just be on the construction cost?
Okay, let's take it one piece at a time.
Okay.
Contractors, borrower can use whatever contractor they want. We do a full vetting of the contractor. Want to make sure they have no bad stuff in their past, that they're currently licensed. They don't have any stuff there where they've worked on projects and they haven't completed them, they've embezzled money, stuff along those lines. But the contractor checks out, they can use whoever they want. We do have an appraisal service in-house. We use national title companies. That way it just makes it easier for us. And once the title companies and appraisers are used to working with us, they actually know what we're looking for. So we have a couple of appraisers nationally that we use all across the country. And as far as the contingency goes, we do have a 10% contingency on there for cost overruns. Modular, it would have a 10% contingency on there also. Now, when they get down to that loan modification, whatever balance is still in there, that goes towards principal reduction. So if they have a 10% contingency, it's a 10% contingency, it's $1 million build, $100,000. They'll just do a principal reduction of $100,000 at the end of 12 months or whenever the loan modification happens. So their balance now that they finance is $900,000 versus $1 million. So it all, and they're not paying interest on that contingency, because only paying interest on the money that they've drawn out.
Okay.
Did I answer your questions?
Yes, thank you.
Okay, no problem. Let's see, investor experience, first time buyers, or they won't allow them. Did I grab the right? I did grab the right. Yep. Okay.
Oh, okay, so like in your investors, what are you looking for? Like how much experience? Are you looking for a resume of their work done? What do you need
Well,
from the investor?
if there's a first time buyer and they've never owned a piece of real estate, they've never managed real estate before, probably not someone I want to jump into. But if they have a history of owning real estate, they've had rental property in the past and now they're building, that's fine. Do I
Okay.
have a specific number of properties they need to own? No. Typically at least one in the last 12 or 3 years that they have experience managing. Prefer to also own their primary residence, so they know what it's like to own a house, taxes, insurance, all the stuff that goes with it. They're going to scrutinize the 1 to 4 or the 4 units a little closer, because managing 4 units is a little different than managing 1 unit. You tend to run into more problems, 4 tenants, all kinds of good stuff.
This would not be good for someone who's like kind of flipping it, like an
No,
investor that's building. Okay.
this is not a fix and flip. This is a long-term hold. So this is for someone who's going to build and hold, not for fix and flip, because it does have the 3-year prepay on it, and they will not negotiate that down. If you want to try and negotiate down to 1 year, give them time to build the house, and they're going to flip it after. That's the reason to keep the 3-year on it, because it is designed for a long-term hold, and that's what the bank
Yeah.
wants.
Okay. Is this like they can purchase land with this? I know you mentioned something that
Yes,
at the beginning, so I
yes.
missed that part.
If you're going to go down the road with the land purchase, and they're going to get new architectural plans, designs, and permits, I caution you with that, because a lot of times you're not going to meet that 12-month time frame. Getting architectural plans, permits, and all that approved, depending on where you're at. Southern California, you're taking 6 months if you're lucky to get those plans approved and checked, and out your construction, you're going to run over on it. So ideally, where it works well is with someone who currently owns a piece of dirt. They've already started looking into plans, architect, they know what they want to build, and their timeline is going to be sped up quite a bit. I've got a client right now. This is kind of a unique situation. Borrower is a contractor. She currently owns 2 lots free and clear. They're building 3 units on each lot. The third lot's owned by someone else that she knows. So she's going to end up building 3 units on those properties, one 3 unit on each property. Our contractor is also our borrower, but because of her experience, we're going to allow her to be her contractor and the borrower at the same time. Now we're going to monitor a little closer, make sure material is being delivered, funds are being applied appropriately, but we will allow those on those exception bases. Moving past the DSCR, this is kind of unique here. I will allow for alt doc on it, bank statements, P&Ls, construction, up to $2.5 million. So this is really designed for that self-employed borrower who wants to do a bank statement transaction, wants to build his house, he owns a lot, can't get financing. He's building in a resort community. It's a $2 million build, $1.5 million, $3 million, $2 million, whatever it is. We will allow that. We'll allow it on second home also. So for your higher end borrowers that are building outside Fannie Freddie's limits, that's not the target audience we're looking for, the traditional full doc guy. Everybody's got that. This is for the guy building the higher end property. Maybe self-employed, maybe he's building a $1 million home, needs financing, bank statements, been self-employed for 10 years as a plumber or auto mechanic, whatever it might be. This would be perfect for him. So we've got 2 great products here. For the one-time close, follows the same guidelines on both sides. It's just the owner occupied, has no prepay with it. We will do bank statements on it. Loan amounts up to 2.5 million. Ratios 40%. We'll consider them at 43. personal bank statements, business bank statements, P&L. I do need to verify the business is in existence. I do need to have operating agreements verifying you own 100% of the business. New business needs to be active and in good standing, verified with CPA. So asset utilization, we'll look at there also. So I know I kind of rushed through it, but does anybody have any questions? Anything?
I just wanted to add one other thing too, Brian, because obviously we know the guidelines now, but no one's priced it out. I think for our scenario yesterday, Brian, the pricing for like a 740 FICO, like 60 LTV was around like 6.5% with
Yeah.
the 3-year prepay. So the rates are super sharp. It's pretty much, is it like your standard DSCR rates? Is it any different than the traditional DSCR?
It's within an eighth of our traditional DSCR rates.
That's awesome.
So when the float down occurs or the modification occurs 12 months out, we look at what is the current rate on that product when they're ready to do the float or the modification.
So Brian, where do you guys source the rents or the income for the DSCR part when you're qualifying?
The appraiser, the 1007.
Just the 1007, and whatever they say, that's kind of what goes.
That's kind of what they're going to use, yeah.
Okay.
I mean, it needs to be realistic. It needs to be marketability for the area. If you're looking at short-term rental, we'll need AirDNA, VRBO. We'll need a history of the appraisal will need to identify other short-term rental properties in the area and show what they're renting for. If he tells me the property's going to rent for $15,000 a month, it may be unrealistic depending on where it's at. And I say that because right now in the short-term rental market, VRBO and these guys are estimating high with what they will rent for. And everybody's questioning a lot of that right now. But if there's a history of that property or a history of another property very similar to it, renting at those amounts, then they're going to use it. If they're telling us, hey, that they get $15,000 a month during peak season, during off season, they get $8,000 a month. They can expect to have this property leased out on average 8 months out of the year at this average income. That's kind of where they're going to go with it because they're going to have that vacancy factor built in. And that's why they do require the higher DSCR on the short term.
And do you see typically when people order the future value appraisal on the construction loan, they also are getting the rental schedules at the same time, like ordering both of those, or are they done separately?
Yes. Nope, they're ordering it all together.
I have another question when you're ready. Can they purchase an existing property that needs renovations and doing that as a one-time close, or does it have to be a brand new build?
No, it can be a renovation.
Okay.
Renovation gets touchy there. If they're going in and they're going to add 2 or 3 units to the property because it's a large property they're buying, that's great. They can do that. There's a couple things they need to follow that we are kind of, we can go over that when you get to it. If you have one, I'll go over what the issues need to be there. If they're buying a single family residence and they want to do a remodel on a kitchen update, bathroom update, and it's $50,000, probably something like that not going to happen. But if it's a $200,000 build, then yes, we'll definitely take a look at something like that.
Brian, do the traditional DSCR rules apply as far as where we're allowed to do this if we don't need to be licensed in a state that
we need to be licensed? I need licensing in the states where you're doing it.
You do need licensing. Okay.
Yes, that's a good question. Yes. Now that will change in the future, but for the time being, we do need to be licensed, have licensing in the state where the property exists or the property is being built.
Is there a minimum loan amount that you finance?
$150,000.
Okay.
How much is the prepayment penalty for that 3 years? Like if they want to pay off?
That's a standard 5%.
It's 5%. Okay, thank you.
Brian, are there any other big hurdles that you see from time to time with these kind of loans? I assume there's more moving parts. Like, are there issues getting the GC approved or any common issues or pitfalls that we should look at?
I would want to make sure the GC is in good standing. Licenses are active. He's got no bad, the GC has no bad stuff in their past history. Because we will vet them. We will make sure the GC is in good standing. If it is, we're going to let the borrower know this probably isn't a GC we will approve, but we can approve your project for you. Because I don't want to get in bed with a GC that has a history of not completing projects, doesn't have a history of, has complaints from poor quality of workmanship and other things like that. So just, I'd be cautious with the GCs. Just make sure they're working with a reputable, high quality GC, not someone who's fly by night that's only ever built 2 houses.
Okay, cool. Makes sense. Awesome.
And if the person that's buying the property is a GC or has done that, is that allowable?
It will be on an exception basis. Yes.
Okay.
Now, there's another way this product can be used, and people really don't look at it like this. Some of these borrowers are buying homes in new developments. Some of them are small. They're buying from a small builder and maybe building 15, 20 homes. The borrower can actually go in and buy that property, do a one-time closed construction loan on it. We'll pay the builder to build that house in their development. What is it? Why would a builder do this? Well, it takes the construction cost off his line, so he's no longer carrying the construction of that property. It guarantees them they get paid. Now, a couple things to watch out for in doing something like that. Crazy upgrades, paint carpet, paint tile, floors, stuff that just doesn't make sense. Because sometimes that property is hard to manage and deal with. But, you know, if they want to add granite, countertops, and all that stuff is normal for the market, it can add value to the property. They will allow them to do it.
So when they do these one-time closed constructions, what is the minimum payment? Just interest only on the draw amounts, or how?
Yes.
Yeah. Okay.
Interest only on the draw amount.
Yeah, makes sense.
Okay. I think Austin has all my contact info. If you guys have any questions on any of this, give me a call anytime. I think I sent Erica the matrix and asked her to send it out to everybody. You guys get my contact information from Austin, or if you want to write it down. My name is Brian Jensen. I'm with AP Bank Wholesale, and my direct line is 951-212-6346.
Thank you so much for doing this for us, Brian. I look forward to finding some loans.
I look forward to working with you guys, and if I can be of any assistance, please reach out, give me a call. You guys have a great day. Thank you.
Thank you, Brian.
Appreciate you, Brian.
Thank you.
Thanks, brother.
Bye.
And happy Halloween.
Happy Halloween. Bye-bye.
And guys, remember, it is Halloween. If you got any of those extra business cards after we changed our names to Nexa Lending, hand them out in the little candy bags for all the kids and the parents and whatever you want. That's what I do too. I put my cards in the little candy bag so they know it's safe. They can eat it on the way.
Oh, yeah.